Investing can be rewarding, but also risky, so always stay informed. This video is for education, not financial advice. Think you have a diverse portfolio? It might not be as varied as it seems. Picture a closet with 20 shirts, but most are black or dark colors. You have many items, but little real variety. Portfolios can be the same way, many funds and stocks, but often tied to the same sectors or countries. This hidden overlap can increase risk. I'll guide you through a simple 4-layer check to reveal what you truly own. This helps spot repetition and improve your diversification. Understanding your portfolio's real makeup is key to smarter investing. Let's explore how to diversify wisely without guessing the next big winner. When building a portfolio, focus on engines, not just investments. Ask, how many forces drive my returns, instead of counting funds. Meet James, who owns a U.S. index fund, a tech fund, and an AI fund. He thinks he has 3 separate investments. But many top companies overlap across these funds. When those companies rise or fall, all 3 funds move together. This means James may have one main engine wearing 3 labels. His risk isn't as spread out as it seems. This isn't bad, but it's important to know. Fund names show the product, but holdings reveal what you truly own. Counting engines helps you understand real diversification. Focus on what drives returns, not just the number of funds. Where your money lives matters. It's not just about what you invest in, but where those investments are based. A company's success depends on its home country's economy, currency, and rules. These factors shape how well your investment performs. Emily invests only in one country because it's done well for years, but betting on one place forever can be risky. History shows us that leadership in markets shift over time. New industries rise, currencies fluctuate, and politics change business landscapes. Global diversification isn't about predicting failure. It's about accepting that no one knows which region will lead next. Think of investing like farming. Planting crops in different fields spreads risk, so one storm won't ruin your entire harvest. The 3rd layer is the expectation check. It helps us separate great technology from great investments. New trends often attract huge attention and excitement, but not every breakthrough makes a good investment at any price. A technology can change the world and still disappoint investors. This happens when the price already reflects perfect growth. Take FutureGrid, a company making factories more efficient. Its tech might succeed, but shares can still fall if expectations are too high. The company doesn't need to fail to disappoint investors. It just needs to fall short of extremely high expectations. So, ask not just if a trend will matter, but what success is priced in. Excitement sees possibility. Investing demands clear expectations. The 4th layer is the sleep check. It tests if your portfolio suits your emotional limits. Oliver invested heavily in fast-growing companies. When prices dropped, fear made him sell quickly. His mistake wasn't picking the wrong stocks. It was choosing a portfolio too risky for his feelings. Before taking extra risk, ask yourself 3 key questions. Can you hold through a major decline? Would you still sleep well if prices fell further? Are you using money you might need soon? A portfolio must work on paper and in your mind. It should survive market swings and your emotions too. Your portfolio's health depends on 4 key checks. Remember them as engines, geography, expectations, and sleep. First, find the true engines driving your returns. Know what really powers your investments. Next, assess if your money leans too much on one country or region. Diversify to reduce risk. Then, separate excitement about a technology from the price you pay for it. Avoid overpaying for hype. Finally, ensure your risk level matches your ability to stay invested. Comfort keeps you steady through ups and downs. This isn't about complexity or chasing every trend. It's about building a portfolio that works across many futures. Start by listing your main investments on a sheet of paper. Write down their largest holdings, sector, country exposure, and why you own each one. Look closely for repetition across your investments. Are the same companies or markets appearing too often? Check if your portfolio leans heavily on one market or sector. This can increase risk without you realizing it. Ask yourself if you bought each investment for a clear, long-term reason, or was it because the story around it felt exciting? Decide how often you will review your portfolio. Regular, calm check-ins beat reacting to every news headline. A thoughtful review helps keep your investments aligned with your goals. This steady approach supports long-term success. Diversification isn't about owning the most investments. It's about limiting how many surprises can hurt you at once. A strong portfolio doesn't need you to predict the next big sector. Instead, it's about knowing your risks and exposures clearly. Avoid accidental concentration that can put too much at risk. Choose a level of risk you feel comfortable living with every day. The best portfolio isn't the one that shines in a market boom. It's the one you understand and can stick with through uncertainty. Holding steady when the future is unclear is what really counts. That's how you protect your investments over time. If this helped you, please like and subscribe. We'll keep bringing you clear, practical finance tips you can trust.